welcome back to another episode of the Finance Bible podcast. Zeke here.
And your co-host, Oscar. But before we get into it, please note that nothing in this podcast should ever be considered as personal financial advice.
Of course, if that is what you are seeking, reach out, we'll get you in touch with the correct professionals, get the job done properly.
Sit back, relax, and enjoy the show.
Let's get into it. And today, guys, we're actually joined by Raymond Hempstead. He's a director of a company called Supavest, which focuses on things in superannuation. And we think a pretty vital guest to actually have on to get you guys learning more about superannuation and products that you can actually build in there and learn more about that. Welcome. Pleasure to have you here.
Great. Thanks for having us.
Let's just jump straight into it. So Supavest, the company, how did that come about? Like, why did you decide to do a company that focuses on superannuation and building that up?
My dad lost a whole pile of his super in his early 50s. In that, he never recovered. He took some bad advice. He liquidated his losses at the bottom of the market. And he retired on the government pension. So I saw my dad go from a decent six-figure income, retiring, and then literally going next to nothing. He had his family home with mum and not much else. So that was in the back of my mind. Then about 3.5, 4 years ago, I had two clients that had bought two NDIS properties off the plan from us just for themselves personally. And the day before the land was due to title, they came back to me and they said, we can't afford to purchase them ourselves. We want to put them into a self-managed super fund. I was like, okay. Now my background's accounting, and it was like, have you got a self-managed super fund set up? No.
That's a good question.
Yeah, it was
a valid question.
Anyway, like they didn't. It couldn't be done. Like they wanted to take debt and build. But what that did, it tied in with my background in seeing dad and mum retire badly and looking at these guys had a good idea to put high cash flow properties in their self-managed super fund, but it's illegal. You can't do it unless you're going to pay cash for it. And so that because of that, it started my mind thinking, how do I invest? And it was like, I choose my builder, I choose my location, I choose what I want, and then I go and build it. But you can't do that. You couldn't do that in your super fund, which frustrated me a bit.
Yeah, I remember the first time you actually you came through to us, and the first time I met you actually, and you said, "Hey, I've got this product, this solution to building property in your super fund." I was like, "No way, you can't do that.
Can't do that. It's illegal."
And then next minute, we sat down, and we probably sat down for a couple of hours chatting it out. And yeah, you've done it, you've put it together. So congratulations to you.
That was what 3.5 years ago.
That was a while ago. Yeah, that would have been maybe mid 2020.
Yeah.
Possibly. It was definitely COVID times.
Yeah, no, it was.
It was exciting being able to actually meet someone I didn't know. So, yeah, you brought a bit of happiness to my life there.
I'm glad. Thank you.
There you go. in your mind, obviously you're very into property investment. Why, for people out there who haven't dabbled into it before, and perhaps they're super as well, why is investing in property so important for yourselves, but most importantly for your future self, like your retirement?
I see the stability of like bricks and mortar. Like the markets might go up and down, both real estate and the share market, but the bricks and mortar, I can actually walk up to a rock and say, kick the rock, that's my rock. I own it.
Yeah.
And if the market goes down, it doesn't matter. The rents that are coming in, they're not going to go down. And I'm not going to get a margin call from the bank saying, oh, your house price has gone down, pay some money on the loan.
That'd be tough.
So it is what it is. It's solid. And I look at my dad again, like getting to retirement and having to stress about where your money's coming from. Like the hardest point for me was, again, during COVID, dad got very, very sick. And his biggest stress, he knew he was dying, wasn't that he was dying. It was he was stressed about how he was going to support mum after he passed.
Yeah,
because he knew he didn't have enough money. How do you
tough pill to swallow?
How do you get to that stage of your life and still have to be stressed about money?
Yeah.
And so real estate, I see that it gets paid off. It's got regular income coming in that you can count on every week. and most people live week to week on their wage right now.
Yeah.
So I've only got a small amount of shares, but if you think about, I look at the share market. If I'm now dependent on an external company deciding whether I'm going to get paid dividends this year or not, or this 6 months, that I need to be able to live on for the next 6 months.
Yeah, or whether you can actually retire if they're going to perform well or fall off the cliff and then you've got nothing.
Or the share market drops in the year that I want to retire.
Yeah, it can happen.
The timing for that would be outrageous, and it happens. I've seen clients actually. Formerly, I've had a client pass away actually during COVID again, not related to COVID, but they passed away, and their partner was like, "Okay, well, I'm stopping work." Blah blah blah. They were old enough to retire, and guess what? The market was down 30%.
Yeah.
So she's lost her husband. Her shares are down 30%. Life, like it hits you.
It is.
So that's a fair reason for you to say, jump in property as opposed to shares, and why you focused on that. And I respect the background of saying that it was, due to your dad and your family, because, helping your family do something and learning from that and then translating it to other clients and or general public, that's a huge, huge step to take. And speaking of external companies deciding, whether you get a dividend, let's talk about actual general super funds, your CBUS, your Oz Super, all of that.
See them on TV with the hand gesture.
Yeah.
How much have they spent telling you that's a really good symbol?
On the TV.
Just the hand symbol. How much have they spent on that?
Probably more than they've made for everyone in the world.
Because they've been doing it for a good probably 20 years.
Yeah,
as long as I've known.
I think it was
But whose money is that they're spending?
Ours.
That's right.
Yeah.
But if they're spending your money to tell you that it's a good idea to actually give them money to actually tell you that, I don't get it.
Yeah.
What are your views on industry super funds? I can already feel the tension with these industry funds.
About the water
I'll have a Shivers 18, thanks. No. I believe people need to have choice. Up until now, until Supavest, people really haven't had a valid choice outside of the industry super funds. Like they've done what they've done over the last number of years in taking people's money, investing it, and a whole lot of people making a lot of money out of that money, not necessarily the people that gave it to them. Yeah. I look at the amount of money I think it was $160 million last year from the 12 leading APRA funds that was spent on advertising. There was another over $40 million that was paid to, and this was a Sun Herald article that came out a month or two ago, over $40 million, or up just under $40 million that was paid to the union subsidiaries of the government funds. So you're looking just across those two, $250 million of hardworking Australians' money that have been paid to who? For advertising and to union or associated entities to support the government, to support themselves, to support the unions. Now, it's all valid, but up until now, there hasn't been the education out in the market to be able to show people how they could do something different with their super.
Yeah.
Because, you could set up a self-managed super fund, but what are you going to invest in? Shares? You can buy collectibles, you can buy some property. But what sort of property are you going to be buying? You're going to be buying negative geared properties. Because you can't buy high cash flow properties because they're valued too high for the... So now, I suppose, where we come in and I suppose working on the generational wealth philosophy, you have to build something to create wealth.
Yeah.
And that's what Supavest, it allows people to now build the right type of property using their super and then move on from there.
And that leads to the product we talked about, the safe property.
Yeah. So I suppose my idea of investing, it's got to be positive cash flow. So I'm not into this. I'm not into negative gearing. All right. I
fully agree with you.
Yeah, I'm not into that.
No, neither am I.
So if you're investing in something and it's giving you more money than it's costing you to own, that's positive geared. Getting high cash flow properties, you're looking at spending between $1.3 and $1.8 million in a residential setting that's giving you 9, 10s, 11% returns, which is very substantial. You need $400,000 plus deposit to be able to get into that.
hefty sum of cash.
It is.
Lots of years of working.
Lots
If
of
you're
years
under
of working.
30, pretty much 0%
Impossible.
chance.
Very much, very much. So I looked at that and I said, okay, if I build one of those and then sell 5% shares, I sell 35% of it in 5% shares, right? Under tenants in common. So it's a fractionalized investment. You're not buying units in a unit trust or shares in a company. You're actually buying 5% of a property and you're on title. Now, if you own that 5% of the property, you get 5% of the income that comes in from that property. And where most of the properties we deal with are around the 11 up to 11% returns. That's paid monthly because rents are paid weekly, and from the management companies that's paid out monthly. So you've got a monthly income.
Which is a great return for anyone who doesn't really know returns too well.
Yeah,
11% is
It's up
pretty
there.
substantial.
it is. These are high cash flow properties that usually only the upper, like the wealthy or people that have got $400,000 or $500,000 to invest, can actually partake in.
Mm.
And these are dealing with quality NDIS properties, co-living, rooming houses, properties supplying a huge demand for what we need in Australia. And so you've now got the ability to have average Australians that have got, whether they're doing it into their super, we've got some people that are doing it outside of their super, they're saving for a house. So rather than parking their money in a bank account for 7 or 8 years while they're saving,
Yeah.
they're saving a bit, they're taking it and they're parking it into a safe property. So they're getting up to 11% return and they're picking up the capital growth as well on the property.
Mm.
So they're saving 2 or 3 years in saving because they're picking up capital growth on that as well. So that whole safe property opens up the market to people that want to get into the market that don't have enough cash and they can build up to it. We've got some guys that are coming up to retirement that they've decided to take 250,000, 260,000 and working with their financial advisors and buying four lots of safe property shares in 4 different properties.
Yeah.
Because it's going to give them a better return than what they're getting if they're not in the market.
Yeah. So they get the diversification. They can choose where they're doing it. They're getting multiple properties. And whereas if they just threw that 250 grand elsewhere, it's either in shares, fixed interest, or possibly they're buying, like putting a large deposit down on an established existing property that might not return as good of a yield. So it makes sense to me.
I don't know where you can buy an established property that's going to give you, hey, if it gives you 4%, maybe 5%.
Mm.
But if you're taking out a loan against that, what's the loan going to cost you?
Yeah, you have to be
Depends how much you got.
throwing a fair bit down.
Yeah. If you've got a hefty savings, you could be neutrally to positive, but majority of the time, it's tough.
Exactly. So if you're going to invest and you don't go negative geared, and you want to pick up capital growth, you need some long term. But if you've got only a short period of time before you retire, then you need to be getting into property assets that are returning you good income.
And especially if you're an investor at the moment who has negative gearing properties and you prefer that, you've got to be willing to cover the losses until you get the tax return.
Yeah.
Which realistically you can only do that if you're on a hefty income, because a lot of Australians can't afford to fork out extra money per week, per month for an investment they have when they're paying rents and their own mortgage off.
Exactly. And I suppose, look at the current environment. People are stressed and struggling now, day-to-day living. Being able to do that investment now inside an SMSF and use your superannuation money to invest into property, you're not affecting how you're living day-to-day because it's not coming out of your day-to-day income.
2 different worlds.
It's 2 totally separate buying capacities. Like we've got a couple of clients now that are 4 and 5 generation renters that they're hardworking Australians, and that one of them had just under $400,000 in their super with husband and wife. They're becoming their first property owners effectively in 5 generations of their family, because they're now buying a property, an investment property inside their self-managed super fund.
Yeah.
Now, the sheer joy on this couple when they realise that they could become property owners it's like, I'm the first one in my family to go to uni. These are the first ones to actually own a house in 5 generations.
Yeah, it's just a big good feeling.
It's insane though, because if like self-managed super funds and safe property, for example, is advertised on TV, a lot of people would jump into it. People just don't know about it.
Yeah,
that's the issue. That's why a lot of Australians can't afford to retire and work until 70, 80 onwards.
But like, Supervest, like outside of Safe Property, we are actually building those. But Supervest itself is literally just a financial product that allows you to choose what you want to build. Like we don't tell you, like the only have tos, you have to have against a block of land and it has to have a 35% deposit.
Mm-hmm.
All the rest of it, where you build, what you build, who you build with, what type of stuff you build, that's all up to you and your advisors. Like we've got some guys that can direct you if you need some help, but it's your money. Like you should be able to choose what you're building it and where you're building it. Like I'm from Queanbeyan, just outside of Canberra. Now, if you might think Queanbeyan's a great area to invest.
Go ahead.
Go ahead. Like if you want to build in Canberra, if you want to build in,
You're not going to say no, it's not. I reckon that's horrible.
yeah, but see, that's my opinion.
Yeah,
It's
exactly
your
right.
money.
You get to choose what you want to do with it.
I'm just saying we have a solution that takes any land and house package and turns it into a single part contract that your super fund can now purchase.
We should explain that as well, actually. For those of whom haven't listened to any of our former episodes on superannuation and property and superannuation, you can't go out in the general market, buy a block of land, talk to a builder, and get a build contract to build on that block of land. You have to do what's called a single part contract. So either buy established property, like existing property, and or a townhouse unit, something like that off the plan. You can't actually just go find a block of land, talk to your favorite builder, and put something on there. That is a Supervest product, which actually amalgamates the two of them together, so you can have that flexibility.
Yeah, exactly. Like there are some builders out there that are providing single part contracts.
Very steep.
They're steep, but my attitude is they're building that property in one location. The reason they've chosen to build it in that location is it's a good investment for the builder.
Yeah.
You're their exit.
Yeah, they've got ties.
So if you're buying a single part contract off of them, you're their exit. That's how they make their money. So it might be a good investment. I'm not saying it's not. It might be. But what we say at Supervest is, here's Australia. Where do you think is a good investment for you?
You find it, we'll help you with it.
Yeah. If you want some guidance with builders in that area, we can help you. If you want to go and do it all yourself, go for it. Knock yourself out. And we'll package whatever you find and make it a single part contract so you can have it in your super fund.
So with, you've got Supervest, you've got Safe Property. What do you think is the minimum amount for people who don't have too much in their super fund? What do you say the minimum amount is to get started and to actually start building your investment portfolio within your super?
We're seeing guys come that have got $85,000 in their super. And they're setting up their self-managed super fund and they're buying a safe property with the strategy of now building multiples of those in their long-term strategy. So it's where, I suppose it comes back to, if you're not going to talk to a financial advisor or an accountant to guide you, where do you want to be in the next X number of years? How long have you got until your retirement? What sort of lifestyle do you want? And it's pretty easy to see if you're currently living on $80,000 or $100,000 a year and that's your lifestyle. If the government pension is 30 plus anything you make out, like the government says, if you've got $70,000, $690,000 in your super as a couple by the time you retire, you'll retire on about $70,000 a year. Now, what they don't tell you is over half of that's the government pension. But can you live on that as a couple?
And will it continue at that point in time?
Yeah.
Yeah, I saw something insane. I think it was maybe 6 months ago. I think it was actually a little bit less than that, saying you could live off like 300, 400,000 in your super for retirement as a couple.
It's amazing reading the different information out there. So, like, comfortable retirement on some websites is like 40 grand a year.
Yeah,
I don't even think that I can live on 40 grand. I'm in my 20s. Like, how's that going on?
How do you live off? Yeah, it's just ridiculous.
Like I just came back from overseas. I spent a couple of weeks over there seeing my mentors overseas. Now, I chose to fly business class going over there with myself and my wife. It's a chunk of money. My son just went overseas to watch an LA basketball game for a week, and he travelled economy.
Yeah.
Good on him. His money.
Yeah.
He still spent, I think it was all up about $8,000 for the week as a single guy.
That's a good week.
It was
It's a good week.
But that was Now, if you want to travel as a couple and now you're in your early retirement years and you're going to spend $8,000 per couple for a week, I know it costed me over $100 US a day for each of myself and my wife. So 200 US a day to eat when we're over there, and we weren't going crazy.
Yeah, I was recently over there as well. And I would have spent, I think I was over there for about 3 weeks and I would have easily spent 25, 30 grand. So if
Yeah.
you're, and I actually say this to a lot of clients too, like when we're trying to figure out how much they want per year in income in retirement, I actually add a bit on to what they're currently doing because when you're retired, you're not going to work 40 hours a week.
No.
That 40 hours a week, you're very bored. What are you going to do? You might go play golf. You might go on little holidays around Australia. You might buy a caravan and tour Australia. You might go overseas and drop 30 grand in 3 weeks.
It's like you spend more.
Yeah, you
and then
spend
you've got
more because you're bored.
grandchildren. If you do, you want to spoil them, take them away.
Yeah.
It's
I know with my dad, before he was retired, him spending time with my kids, they'd do stuff together.
Yeah.
As soon as he retired, they didn't do anything. They couldn't. They couldn't afford it. At times, I saw them double using tea bags.
Yeah, right.
They'd have a cup of tea and they'd put the tea bag on a little saucer next to it because that's how stressed they were about where their money was at. Now, so yeah, where do people want to end up in retirement? Like what sort of lifestyle they want? Once they figure that out, then work backwards. And what asset class is going to give you consistent monthly income, not yearly or half yearly, monthly income that's going to support that lifestyle, whether it's a good economy or bad economy. Because like we've all been through COVID, what happened to a lot of the incomes, the people on the share market during that period of time?
See you later.
I would have hated to been living on income
you'd be
coming from the share
screwed.
market. Yeah. But yeah, there was a bit of a dip in rents and there was a bit of a holdback on rent, but all the rents were caught up because if they didn't, what happens to people if they don't pay their rent?
Goodbye.
Well, yeah, you're out.
You're out.
See you
And
later.
what happens to your rental CRA, whatever it's called, when you go for a next tenancy?
No good.
No good. So why do people pay their rent? Because they know if they don't, they've got nowhere to live if they got to go.
Yeah.
Yeah.
So from an investor's point of view, if I'm providing quality accommodation through my super fund to other people in Australia and giving them quality accommodation for them to live, then I'm guaranteeing my lifestyle and my future lifestyle.
Mm.
And so it's a win-win. So the other thing I like about it is we talk about industry super funds. Where's a good chunk of that money? Is it in Australia or is it offshore?
Mostly overseas. And again, depending what you're investing in, like you
which
can manage it to an extent.
Like high growth, etc.
Yeah, a lot of it is like I think I can't remember what fund it was. I read a statistic the other day, and it was like 60% odd of their actual investments of this particular portfolio was on the Nasdaq.
So
That's an American exchange.
100%.
I know Australian Super's like that.
Yeah.
They've got a fair chunk in the Nasdaq as well.
Yeah.
So you're building someone else's economy.
Yeah.
When you take your money out of the industry super funds and put it into a self-managed super fund and you start building quality Australian properties here in Australia, you're actually building Australia. You're building homes for Australians, you're providing jobs for Australians and keeping the money in Australia, growing Australia. So how much more security is like, look what's happened to all of our services and we've shipped them offshore. What do we manufacture here these days? We're relying on offshore.
Yeah.
So if all of
Barely
our
anything,
money
yeah.
is offshore, we're relying on them to actually give us our money back. But if we've got our money and we're making our money out of Australia, out of Australian homes, supporting Australian families, now when I retire or people retire and they know their money's coming from Australian homes, supporting Australian families, that's secure.
Yeah.
As secure as you can get, in my opinion.
And you feel good. You've helped your country, and you also feel good that you've got a nice asset in your super.
Yeah.
It's
a win-win.
A major pain point with clients as well when they're investing in shares and that is they don't know where their money is. If they've got the property, they can literally drive to it, see it, and go, "Yeah, that's mine." And it's a
100%.
Touch it, hug it.
Yeah, some of them do hug it.
Yeah,
Can
some
confirm.
people love it.
Like I've seen, we've had clients say when they talk to us, where do you want to invest? I need to have it within 2 hours of where I live.
Mm.
Why?
Yeah.
Because
because I want to drive there and see it.
Yeah.
And that's literally the only reason.
That's it.
Like, if it's costing them money, they don't care. They just want to see it.
Yeah, that's it. Like they could be buying on the other side of Australia, getting better returns, but they want that location because
It's
they
too
want the
far
comfort.
away. Yeah.
Yeah.
But
It's
see,
familiar.
yeah, is that right or wrong? That's right for them,
It's subjective, yeah.
but it's their money.
Exactly right.
They should be able to do with whatever they want with it.
For individuals who are getting to the later stages of their careers, they might think they've missed the boat with investing and with their super. How late is too late, or is any time you can jump in and invest?
Oh, like we've got some guys that are a couple of years away from retirement, and they haven't got a lot of super, and they're buying safe property solutions, and they're getting multiples of those because it gets them constant income. We've got other guys that are 4 and 5 years away that are now taking a strategy of building high cash flow properties. And let's talk about a high cash flow property. And we talk about NDIS properties. Now, done properly, NDIS properties are an amazing product because they provide a huge need for the disabled community in being able to give them quality accommodation, but it also gives some amazing returns to the investors. So you can be dropping 1.2, $1.3 million and getting between 150 and 190, $200,000 rental return out of those properties. Now, if you think about it, if that property is costing you in expenses and mortgage repayments 90 to 100, but it's bringing in 180, you've got another $80,000 cash income being put into your super fund every year on top of your normal contributions. So depending on the strategies, you can have 2 or 3 of those in a fairly quick succession. And so you could have 3 properties that are each bringing in net income of 80,000. So you could be living on $240,000 worth of income while still paying off the properties. So it depends on lots of different situations, but
Of course.
that's a strategy that we've got clients using today. So that sort of stuff you can't do if you're going out and trying to buy established property.
Yeah.
Because you can't build that sort of wealth and that type of asset in the right location to get that sort of income out of it.
Yeah. And I think the biggest roadblock for people that are trying to do that with the NDIS housing is they don't know where to do it. They don't know how to do it. They don't even know really anything about NDIS and what it actually is. So do you guys provide the information on that and how it works, who they can talk to, or how does that kind of work from a client perspective?
Over the last 3.5 years, we've now worked very closely with about 4 the service providers that look after the individual disabled people and provide the associated services. Along with that, we then work with a range of builders that build the right type of houses around Australia. Because there's a lot of people out there flogging NDIS properties.
Yeah.
And unfortunately, they're marketers. They've got huge commissions in it, and that's why they're doing it. They're not associated with SDA or SIL providers that look after the actual participants. They're just selling you a product with a dream where when you're dealing with an SDA provider and building an SDA home, you should be looking at it from the participant's point of view and starting there, not starting with the property and then working backwards. It's the participant that you've got to be looking at, building it for them and then building something that suits their needs and their requirements.
Yeah, you do it right and the money will come back.
Yeah.
As opposed to doing the right thing the wrong way.
Just simple best interest duty.
100%.
Literally simple as that.
Yeah.
We hope you enjoyed the episode. As always, you know exactly what to do.
Hit that follow button, subscribe, whatever platform you listen to this podcast on. Also share it to your friends, family, co-workers, whoever you think may benefit from it. But unfortunately, it's the end and we'll see you next week.